Okay, so good morning, good afternoon, everyone. Um, Today's session is all about financial metrics and the viability of that within the US retail market. So I know that the word financial calculations can sound scarier than a haunted house to some of us, but don't worry. While we're going to be diving into a lot of numbers today that could, kind of even intimidate a seasoned mathematician, I promise by the end of it, you're going to be armed with everything that you need to succeed without needing a PhD in math. The best part of it, you don't need to memorize anything. Okay, everything is going to be available for you to download afterwards. Um, so relax, grab your calculators or don't, um, and let's make these numbers work for your product success. So the format of today's webinar is going to be slightly different. It's going to be a shortened version of what we normally do because it has significant calculations and formulas inserted into it. Um, and if you don't mind, today we're going to be asking you to take a poll at the end of today's session during the Q&A part. It just helps us curate the content of what we show you guys a little bit better. So as I said, don't be intimidated by what you see today. We're definitely here to help and just provide you with a little bit of guidance into costings. So in the webinar today, we're going to be covering a couple of crucial financial topics that are going to help your business not only as it enters the market, okay, but also to assist it in terms of thriving long term. So we're going to touch on a couple of key topics, and these include understanding the customer acquisition cost, which is referred to as CAC or CAC, and the customer lifetime value, which is the CLV. We're also going to talk about um, understanding the financial impact of the customer journey. We're going to have a look at funding strategies for initial marketing entry and how to um, and some viability in terms of return on investments, how to calculate your ROI. And very, very important is the financial planning and risk management key. So that's one of the elements that we're going to be touching on towards the end. So I'm going to get started. So one of the fundamental aspects of entering the US retail market is really, really understanding what your customer acquisition cost is going to be. So those of you that ever watch Shark Tank, the TV series, a lot of the times the people that are making a pitch are asked, what is your customer acquisition cost? And sometimes people know and sometimes people don't. But I think it's, from my own experience, it's critically important to actually figure out what that is. And we're going to show you how to calculate that today. But then also very important is to understand what the customer lifetime value is going to be. So that's that CLV part. So these two metrics offer insight into how much you should be spending on acquiring customers and what the ultimate value that they're going to be bringing to your business is over time. So, customer acquisition cost. Simply put, uh, the cost of attracting a customer divided by the number of customers you've gained equals your customer acquisition cost. Okay. So basically, it refers to all of the costs involved in acquiring your customer, including marketing, sales, and any other related expenses. So if you spend $100 to acquire your customer, you need to ensure that their customer lifetime value justifies that investment. And that all figures back to the customer acquisition cost. So very briefly on customer lifetime value, which I'm going to delve into a little bit deeper. If you have a look at, using the Eiffel Tower as an example, you've got your market analytics, which we've covered before, and your customer behavior, which we covered in one of our previous webinars, and how that flows up into having a look at where you position your product, your targeting, your market segmentation, and then ultimately setting yourself up for success, which is how you're going to be communicating, pricing, your distribution channels, and the design, testing, etc. So all of these elements have a cost. Okay. So for example, if a customer is going to be bringing in $400 over the lifetime, but it costs $100 to acquire that customer, that means that you're in a good financial position. So that's why it's so crucial to ensure that your customer lifetime value outweighs your customer acquisition cost. And it allows you to make informed decisions about marketing spend, what your pricing should be, your customer retention strategies. All of these things are absolutely vital when entering a new market, particularly here in the United States. The US retail market is a very, very, very competitive market. So understanding all of these metrics is crucially important. So the customer lifetime value. Customers are not always immediately profitable. Okay. So sometimes you've got to invest upfront to acquire those customers. And this is where a lot of products from Africa that are entering the US market for the first time sometimes fail. And that is because you've got to sell your story. You've got to sell the customer on an item that they might not necessarily have seen before. And all of that comes at a cost. So, here's a little bit of a graph that we utilize on the right-hand side of your screen. So year one, that's really where your acquisition costs come in. Okay. And then year two, your profits kind of start to stabilize, but you start to see increased usage, okay, a reduced selling effort, and then sometimes you can actually start charging a price premium because demand starts to exceed your supply. But very, very, very crucial is that life cycle journey, and I'm going to touch on it later on in today's webinar, which is your referrals. So imagine you own a retail store and a customer walks in and buys a $10 product. On the surface, it seems like a very small transaction. But if you take a step back and look at the bigger picture, that same customer could return to the store multiple times over the next years. They might spend $50, $100, or even more over time. So that really defines the customer lifetime value, right? It's the total value that a customer brings to your business throughout their entire relationship with you. So it's essential that CLV is essential because it helps you see beyond a single transaction, and it helps you make better decisions on how much to invest in acquiring customers and how much to invest in retaining customers. So again, for example, if you know a customer is likely to spend $500 over time, it might make sense for you to spend a bit more to attract them in advance, knowing that your return on investment will be far greater in the long run. So the determinants of a customer lifetime value. Obviously, you've got your CAC, which is your upfront cost. You've got your margin. Okay, and that's the money earned from a customer over time. And you'll start to see that there is some acronyms built into today's webinar. All of these are defined later on. So don't worry if you see a V or the P or the K over here. These all form part of a formula, which I'm going to show you a little bit later on. And then you've got the lifetime, right? So the margins can only be counted in the time periods in which the customer is still an active customer, right? So your ultimate goal is to try to keep your CAC as low as possible and your CLV, your customer lifetime value, as high as possible, as long as possible, right? So that ensures that you're not just acquiring customers, but you're acquiring profitable customers. Those customers that are going to stick around and provide value to your business over a long run. And again, I encourage you to have a look at our previous webinars where we talk about customer retention and making sure that you have a look at how you actually retain your customers over time. Again, I always say that it's difficult enough to get onto a shelf here in retail. It's harder to stay on there. So by understanding all of these financial metrics, it allows you to be able to cost your product that is going to a retailer correctly in advance. It's always easy to come down and put a product on promotion or something along that line. It's very, very difficult that once you've set your price with a retailer to go up because you haven't costed your item correctly. So calculating the customer lifetime value. Okay. How do we do that? And here's a couple of basic formulas. So your basic formula over here is that your CLV, okay, is the average purchase price by the number of purchases per year by the average customer lifespan. Basic example, if a customer buys your product 5 times a year, spends $20 each time and stays with your brand for 3 years, your CLV is going to be 20 times 5 times 3, which is 300. Okay, so that allows you to start making a informed decision. However, if the lifetime period is unknown, okay, you have to start to factor into your costing model what is referred to as a churn rate. Now, this is particularly important when it's a subscription type service or your marketing strategy is around building a subscription type item or something that a customer is going to be able to buy online on a repeated basis. Okay. And there are some really, really scary statistics out there that even the big, home delivery meal subscription services, they have a churn rate of up to 20 or 30% per month. So their customer acquisition costs are extremely high, and their entire marketing strategy is trying to figure out how they're going to reduce their churn rate. And in this case, your CLV is your average profit per customer divided by the churn rate minus the acquisition cost. So again, here is an example that if your average profit per customer is $50, but your churn rate is 20%. So in other words, you're losing 20% of your customers over time, and it costs you $10 to acquire each new customer. Your CLV formula over here is 50 divided by 0.2 minus 10. So in other words, $240. So you can see that same statistic that I used up front, that $300 now drops down to $240. And that's critically important to understand how to factor these elements in over time. And again, having a look at an additional formula, and guys, as I said in the beginning, don't worry about, all of this, writing all of this down, rather download it at the end. And then if you need to be in contact with us to help you with any of the costings, let us know. We're more than willing to do that at no cost to you whatsoever. You also have to be flexible, right? So there is another calculation that we utilize quite extensively here in the United States, and that's the flexible formula. So what this does is it accounts for changes in a customer's behavior over time. And here is the formula. So it looks a little bit daunting, but all of these acronyms are very, very clearly defined, and it's easy for you to actually utilize these. You don't need a big financial calculator or anything along that line. It's once you understand what the definitions are, it makes it very, very easy to understand. So your MT is basically the profit that you make in each specific time period. Your ST is the probability that the customer is still going to be active. Your H is the number of periods, and now that could be months or it could be years. So if it's a year, that's if you've managed to secure a position for your product for at least a 12-month period. But in the cases of doing an LTO, where a retailer is committed to a specific volume over a specific period, that's where that H calculation becomes important. And then obviously AC is the cost of acquiring the actual customer itself. Again, calculating the customer lifetime value. So let's say that the manager of a sailing center, these boat sharing centers that we see here, expects his margins to go up by 10% every year, and that people are less likely to leave as they've been customers for a long period of time. So his retention rate is 50% in the second year, 60% in the third year, and 70% in the fourth year. So those kind of stragglers that he's had along the line have fallen out, but he's acquiring new customers every single year. In year one, his margin is 100. In year two, you've now you've now gained that extra 10%. So his margin on that same customer goes to 110. Year three, it goes to 121. It doesn't increase by another $10. It actually increases exponentially by 10% over and above the 110. And then it compounds in year four from the 121 to the 133. But then if you start to take into consideration the survival probabilities, right? So in year one, because they've subscribed and year one means that they kind of locked in, your survivability is 100%. Okay. In year two, you take into consideration that it might drop by 50%. You are still adding 100 customers in year two, but you've lost 50 customers from the 100 that you acquired in year one. And then very, very similarly in year three and year four, you've got that same ratio. So in year one, when you've acquired 100 customers, that original year one customer, you might only have 21 of those 100 customers that you started with by year four. Obviously, you're looking at adding new customers between year one and year four. But it's crucial to understand that when you're doing your customer lifetime value calculation. And again, here is the formula below. And again, don't worry about the acronyms. They're all very, very clearly explained to you down the line. So in very, very simple math, in very, very simple terms, the formula adds up the profit of each of the 4 periods, adjusted by how likely it is that the customer is still going to be buying from you, and then subtracts the cost of acquiring that customer. So in plain English, exactly what you see up here on the board. It's not a difficult formula to understand, but it is a crucial element to understand when you're actually planning your budgets. One of the other things to take into consideration is discounting, right? Now, this doesn't mean that you're discounting the actual product itself. When you're talking about a customer lifetime value discounting, okay, um, there is a specific formula that you can utilize. And this is basically because of the principle that the money that you're going to be earning in the future isn't worth as much as the money that you have today, right? And that's basically because of two significant things. Number one is inflation, which reduces the buying power of money over time, okay? And the fact that money you have now could be invested elsewhere to earn more, right? So again, there's a basic discounting formula over here, um, with your basic formula and then with your discounting formula. And again, guys, please don't be intimidated about it. We've laid this out very, very simply, but in putting this webinar together, it was difficult not to expose you all to these particular formulas and calculations, because it is so crucial to get it right up front when you're actually doing your costs. Bear in mind, the retail landscape here in the United States is retailers are looking for long-term business. They're not looking for a hit or miss or an in and out. It's extremely complicated when they do their annual resets, etc. And they want to make sure that the product stays and is given the best chance. So it's very, very, very important that you factored all these variables in to the actual cost when you deliver that cost to the retailer. And again, I emphasize the fact it's very, very difficult to go up. It's easier to come down. What we have found from our own experience is that we provide a lot of transparency in our costing models to our retail partners. We've developed very, very good relationships with them over time. They know that we make money. They know that we're not looking to buy market share and make no money, but just to enter the market, because that is not sustainable. It it puts your business at risk, but it not only puts your business at risk, it significantly puts their business at risk as well. Because if you're not profitable and you fall out midway during their cycle, they're now going to have an empty space on that shelf, which they're going to have to fill. So they want to know that you are profitable all the way down the line. And sometimes when you're doing your pitch to a retailer, they're going to ask you about all of these costs and have you factored these costs in advance. A lot of them might say to you, you know, give us a dead net price. So in other words, you're not worried about promotions, you're not worried about advertising spend, etc., etc. That's great, but you've still got to worry about all of these formulas behind the scenes. So a couple of funding strategies for your initial market entry. Okay, and let's run through them quickly. Entering the US market requires capital. Choosing the right funding strategy is going to make or break your business. So the first off is bootstrapping, right? This involves using either your personal savings, reinvesting profits into the business, but while it gives you full control, it places it limits the pace in which you can scale. So bootstrapping is ideal for a business with a low capital requirement, but it can be challenging if you're looking to break into a very, very competitive retail segment or a retail space. And that might require significant upfront investment in your marketing of your products. The second one that we've highlighted over here is venture capital. So VC firms can provide substantial funding, but most often they require equity in return. Okay, so this can be beneficial if you need to grow your business rapidly and access expert networks. However, the downside to this is the dilution of ownership and the pressure from outsiders, from these VC firms for very, very fast returns. You have to be very, very careful when you take on VC funding. Number one, you might have to give up a sizable part of your business. Number two, you might have to, factor in their costs that they're going to want to be repaid, their investment prior to you actually drawing anything out. The third element that you see on your screen is crowdfunding. So, it's extensively used here in the US, not so much used in Africa, but I encourage you to go onto Kickstarter or the GoFundMe pages here in the United States and have a look at what other people are marketing and kind of see what their strategies are and how you can fit into those. So these platforms like Kickstarter and GoFundMe allow you to raise funds directly from your target audience. So you can market your product specifically to a target on these platforms. And it's a great way to validate what your market demand is going to be while you're actually raising money. It's a strategy that works best when you've got a unique product that have a very, very strong consumer appeal. Great way to test your items. And then also, consider grants and loans. So a lot of you on today's session are participants within ATI or a USAID mission or engaged with any one of these missions. I actively encourage you to work very, very closely with your ATI regional reps, with your USAID missions. We are a supporting tool to all of this. Again, emphasize it doesn't cost you anything for us to provide this advice. But it's very, very important that when you're doing your pitch or when you're doing your grant application, that you have considered all of these costs, that you've really considered all of these individual ratios, etc., so that when you make your pitch, it is a solid pitch. Conversely, if you're going to banks or other lending institutions, it's very, very important that you understand what the interest rates are going to be. There are some low interest loans, but traditionally in Africa we used to higher interest rates. So be very, very careful about factoring those costs in as well. But then also have a look at where your product is going to be positioned. So if your product supports sustainability, for example, or local sourcing, you may qualify for specific financial support programs. And again, please reach out to us. We're happy to provide guidance on where to have a look. But also, your first point of call is always going to be your ATI program manager or otherwise your USAID regional representatives. They'll be able to provide you with some guidance and support on the grant specifically. So choosing the right funding strategy depends on your goals, the amount of capital that you're going to need, and how much equity you're actually willing to give up. The key is to ensure that your funding is aligned with your business objectives and growth plans. Crucial. So moving on in terms of funding strategies. Sorry, I'm going to go back one. What I'm going to do now is just discuss with you very, very quickly the customer journey and what that customer journey financial impact is. And we call it the loyalty loop, right? So the next critical piece is understanding this journey and how it's going to impact your financial outcomes. So as I mentioned in earlier webinars, there's 6 stages to the customer journey. Consideration, evaluation, purchase, enjoyment, advocacy, and bonding. So let's have a look at, the first one. Consider. The journey begins when a customer recognizes a possible need. To consider your product, the customer needs to be aware that it exists or is made aware that it exists. What then happens is the customer is going to evaluate the proposition. So after identifying one or more products that might address their need, the customer proceeds with the evaluation stage. So you'll often see customers having a look at 2 products side by side in a grocery aisle and kind of comparing the 2 to see which one is probably going to give them better value. That customer is trying to predict the benefits of each product and assesses how important those different benefits are, okay, or what it costs them. So again, going back to the importance of your packaging, which was, I think, one of our previous webinars, that, evaluation and communication tool is what is so critically important. Then the next step is the customer actually makes the purchase. So having evaluated one or more products, the customer then decides whether or not to actually make the purchase. And if so, which product? And sometimes the customer might need a little extra nudge to make that final purchasing decision. And that might mean that, there's an IRC, an instant redeemable coupon, or it might be on a promotion or anything along that line. So again, critically important to understand what the financial metrics are, the customer acquisition cost that is going to trigger this initial buy. And then we move on to the enjoy. So if a customer enjoys or doesn't enjoy your product, the experience that the customer is going to have in consuming that product really affects what happens next. Okay. And next is the advocacy element. So if a customer enjoys your product, they're likely to speak or write favorably about it and influence their friends, family, associates, etc., both offline and online. So that's where your reviews become so critically important. Conversely, those who've had a bad experience might actually start to advocate against your product. And you need to be able to position yourself to mitigate those challenges as well. But hopefully, most of us enter that bond stage. So that's where that's the final stage in this loop. That's the stage where the customer journey, they've enjoyed it so much that they actually bond with the brand. They form a very, very strong sense of loyalty. They become less price sensitive and are willing to pay a little bit more in the future to buy your brand over a competing brand. So when it comes time to buy again, they usually don't go through the whole decision journey. Instead, they're going to go straight to your brand for the rebuy. So this completes what we call the loyalty loop. So in essence, by tailoring your marketing and sales efforts to each of these stages, you can optimize your customers' acquisition and retention, which in turn positively affects your customer acquisition cost, the CAC, and the CLV. So for example, if you can drive more customers into the advocacy and bonding stages, you're going to be able to reduce your marketing cost over time. Loyal customers are less costly to retain and tend to advocate for your product or your brand. And important, understanding how customers are interacting with your brand from the moment they consider it to when they actually bond with it, um, really helps you make informed financial strategies, and that ultimately improves your overall margins. So assessing the long-term viability and return on investment. It's important to assess not just the initial profitability, but also the long-term viability of your business. And there's a couple of calculations here to help you evaluate that. So that's your return on investment is equal to your net profit over the total investment times 100. So for example, if you're making 2,000 in profit, but it's $10,000 of investment, multiply that by 100, and that's going to give you essentially a 20% return on investment. Um, Next is understanding scalability. You have to ensure that as your business is growing, so do your costs. So understanding the scalability of your operations is critically for the long-term success. So ask yourself, can I maintain profitability as my volume increases? Keep in mind, what works for a small scale might not necessarily translate well into larger scale operations. And that then brings me to diversification. Another important factor in terms of long-term viability for product is understanding market diversification. So can your business expand into new categories or new geographies? Okay. Diversifying your revenue streams and protect against market fluctuations and provide a buffer for better long-term sustainability. So very, very crucial to assess all these factors. It'll give you a very clearer picture of whether your business is in a position to be able to maintain growth and profitability over time. So welcome to topic number 5, costs and margins. Very, very key and crucial to financial viability. So now that your product is finally on the shelf of a big retailer, it's very exciting. Okay. But here's the thing. If you don't keep an eye on your costs, your margin would disappear very, very quickly. Particularly if you have to put it on sale. So it's like stocking a product where the packaging costs is more than what is actually inside. Great for the customer, not so great for your bottom line. It's important to ensure that your margins stay healthy so that every sale you make at retail isn't just about moving product, it's actually about making you money. And here's a quick graph. Okay, so we've already explored the customer metrics and funding strategies, but it's now time to dig a little bit deeper into costs and margin, which is key to staying financially viable in retail. As I mentioned earlier, there's a difference between your fixed cost, like your rent, salaries, etc. Those all stay the same, but your variable cost, such as your production materials, your distribution expenses, those change based on the volume of goods you sell. So knowing how to balance those costs will definitely help you ensure that your margins remain strong, okay, especially when supplying the retailers. Don't take on more than what you are comfortable with. Retailers might sometimes say you need to go into 600 stores or 800 stores or 1,000 stores. Rather be open and honest with them upfront and say, you would rather ensure that you execute properly in 100 stores or 200 stores before you take on that big chunk of 1,000 stores. And they'll understand. Again, I've put together a very simple graph, okay, to kind of show you where your profit and your fixed costs go. So your fixed cost is in the red area. Your variable costs is your blue line. Your total cost is your green line. Okay. Your revenue is the purple line, and your break-even point is basically that index where everything intersects. Okay. At this point, you're not making a profit, but you're not losing money either. So the quicker you get to that break-even point, right, that is what makes you so crucially viable. Anything that you sell beyond that break-even point contributes to your overall profit, which is reflected in the green area. So basically, in summary, to be profitable, you need to sell through units to reach the break-even point where your revenue covers the total costs. Anything after that is the cream. Again, we've included a couple of formulas over here as well. Please review them at your own time. But one of the important elements that I'm going to cover in the next slide is the difference between the percentage margin and the percentage markup. Okay. And there's formulas that are indicated in here as well. So your margin percentage in this particular example is if you buy a product for $15 and you sell it for $20, your margin is 5. Okay. So the margin percentage is 25%, but your percentage markup is actually 33%. And don't get caught in that trap. You don't bank markup. So while knowing your profit margin is crucial, it's important to remember that you don't bank margin. You bank absolute dollars. A high margin is great, but at the end of the day, what really matters is how much actual profit you are generating in dollar terms. So again, for example, selling a product with a 50% margin might seem very impressive, looks great on a sales pitch, looks great to an investor, etc. But if you're only selling a small volume, the total profit might be less than if you were selling a high volume product with a lower margin. Again, it's the absolute dollars, the total profit that contribute towards your bottom line, not just the percentage. So whilst margins give you insight into efficiency, it's essential to focus on both your margins and the total amount of dollars that you are actually banking. I'm now going to touch on something that I think is pretty crucial, and that's financial planning and risk management. Before your eyes glaze over, let me put it this way. Think of planning for your product like negotiating with a retailer. You wouldn't deliver a product to a retailer without locking in the price, payment terms, and making sure that you've planned for every bump along the way. Okay. So whether it's unexpected cost, which increases your product, or shifts in demand, proper planning always helps you to avoid having your profits wiped out. And some of the elements on financial planning, right? Detailed revenue projections. Break down your revenue projections into specific product lines, specific customer segments, and specific geographic locations. Consider all of the factors like market trends, pricing strategies, all of that impacts things like your sales force effectiveness. Accurate cost structures. Analyze your fixed and variable costs in detail. Identify areas that can optimize costs, such as maybe negotiating better deals with suppliers or implementing some cost-saving measures. Cash flow. Cash flow is king. create a very detailed cash flow forecast that tracks your inflows and your outflows of cash over time. In an entrepreneurial business, sometimes the word cash flow is a swear word, okay? But it's important to get to grips with cash flow. Ultimately, it'll help you identify potential cash shortages or surpluses and allows you to make informed decisions about whatever your financial needs are going to be or where you should be investing some of those funds. You've then got your financial ratios. Now, when I started off my my journey and we implemented our first accounting system, I was working through it at one stage and I saw this element called financial ratios. It's important to understand what those are. These are key financial ratios like your profitability ratio, your liquidity ratio, your solvency ratio. All of these are very, very important to understand because it helps you assess your business's financial health and identifies area in need of improvement so that you can make proactive decisions going forward. And then, crucially important as well is having a look at your scenario planning, right? Develop multiple financial scenarios based on different assumptions about the market conditions. And that's economic factors, and not just purely on your business operations itself. What that does is it helps you evaluate the potential impact of various risks, okay, and make better informed decisions. We covered this quite extensively in terms of our webinar on data-driven financial models. So, identifying the risk. Conduct a thorough risk assessment to identify potential risks and how these could impact your business. Consider both the internal and external factors, such as operational risks, financial risks, marketing risks, and strategic risks. Okay, the risk assessment, you really need to prioritize your risk assessment based on the severity and the likelihood of occurrence. And that then obviously goes, very relevant to what happens in South Africa currently. If you're running a production line and there is load shedding, how is that going to affect your actual production? Is it an item that then needs to be thrown away? Do you have to have a look at generators to keep your production lines flowing? All of those kind of things is critically important. And then start to develop your risk mitigation strategies. So develop those strategies to mitigate or eliminate as best as what you can those risks that you've identified. So again, this bodes very well to when you're looking at raising funds. Potential investors, potential grant issuers, etc. They want to know that you understand what the risks are to your business and that you've tried to mitigate those risks as best as what you can. And that includes things like risk mitigation controls, diversifying your operations, purchasing insurance, okay, and developing contingency plans. And then obviously, very, very important, continuously monitor and review your risk management efforts to ensure that they are remaining effective and relevant. So update your risk management and your mitigation strategies because they change over time. Contingency planning. Excuse me, it's a little bit early and I'm wrapping my tongue. So when you've got a product, always try to have a look at, breaking it down into various scenarios. So scenario A, scenario B, scenario C, and what you then need to do is scenario A might be logistics. Scenario B might be power. Scenario C might be something like packaging costs or packaging increases that kind of catch you off guard. So that is your scenario development step. And then have a look at a contingency plan for each one of those scenarios that you've identified, because ultimately that ensures that your vision is realized, okay? And all of these action plans kind of are critically important for testing and reviewing, right? So testing and reviewing is very, very critical. Regularly understanding and regularly testing your contingency plans, ensure that they are effective and make sure that they are up to date. Continuously review those, and have a look at all of the elements that affect your costing model, your customer acquisition cost, your customer lifetime value. Understand all of those, okay, what are both internal and external. So just in conclusion, to wrap up, we've covered a couple of key aspects of financial viability, from understanding the core metrics like CAC and CLV to planning for long-term success through proper financial planning and risk management. Remember that the key to success in the retail market is balancing short-term financial performance with long-term growth strategies. So with that, I'm going to open the floor to Sue for discussions. Quickly, how to get in touch with us. And again, we'll pop this into the chat. You're welcome to scan the QR code that you see on your screen at the moment. That QR code will take you to our website with various contact details, but there is contact details available, and your regional ATI or USAID team know how to get in touch with us, but please feel free to reach out at any stage. So with that, I'm going to stop sharing the screen and hand over to Sue to push any questions through.
Thank you, Gavin. Hello, everybody. Thank you for joining our webinar today. Greatly appreciate that. Currently, there are no questions in our Q&A section, but I do see Fernando's hand up, Fernando Alberto. I will allow your mic if you'd like to ask Gavin a question. Fernando?
Yes. Good morning, everybody. So
Good morning.
I'm Fernando. Yes, I am from Angola. I belong to Viability Corporation. So I have one question. What's gonna be the next step of that project? Thanks.
Fernando, today's webinar is part number 4 of the 7-part series that we've delivered. I encourage you to go to our website and review at your own time the previous 3 webinars, because I think it'll kind of lead up to, where we presented today in understanding those ratios. And again, it comes down very, very much to the particular type of product and the particular target market that you're going to be entering to utilize these calculations, how best to actually cost your product. So hopefully that answers your question. So I think we can move on to
another gentleman, yes. I just want to quickly shout out, I've launched the poll, the survey. So if you go up to the top bar towards the left-hand side, you'll see polls. If you click on polls, there's a short 9 question section. If everybody would like to answer that for us, we greatly appreciate the feedback. Now over to Mapoloko. I'm allowing your mic, Mapoloko. Mapoloko? Mr. Mapoloko is not answering at the moment, but I do see another person that has a question here. So Yama, I'm allowing your mic.
Hi, everybody. Thank you so much again, Given. the topic and the lesson is very, very interesting. And thank you for the knowledge you are sharing that. So according to me, why I be labor, we couldn't have the possibility to use 25 for math. And the competition in the market is very high. People say sell low cost. But for us to have a position in the market, we use couple of customers like businesses like hotels and restaurants. There we can have maybe good prices. But our problem is not a high volume. So sometimes if you expect a 25% for March, we come not to say high volume. What do you think about, and we do all our possibilities to try about the packaging and the labeling. I need your help about this, and I'm ready to do some personal coaching for our level and our project for exploitation. Thank you
Okay,
so much.
so I hope I heard correctly. I think what is crucial to understand is who your target market is. So if you're producing a product that is both going to go into retail as well as into food service for a restaurant, for example, you do have two totally different costing models because you have got different associated risks attached to that. You might have different trading terms, et cetera, et cetera. So it's very important to understand what your margin is that you make on each particular target market. Sometimes you might be able to make a little bit more of a margin dealing with a restaurant, okay, or a restaurant chain, but you have far more security in terms of volume and consistency, etc., in dealing with a retail channel. So again, play around with those scenarios with these financial ratios when you download today's webinar, and please feel free to reach out to us to assist you if you need help with any of these calculations. More than happy to help. So I think maybe we've got time for one more question.
Okay. I just want to go back to Mapaloko again. I think he's put his hand down now at the moment. We've answered Fernando's question and we've answered Yama's question.
All right, great. So everybody, just to wrap up, I know we're on time. Thank you very, very much for joining. Please feel free to reach out for any help and advice. I encourage you to go to the website. You can simply use usatd.org. You can click on the event section and review all of the webinars at your own time, or otherwise reach out to us and we'll actually send you a PDF copy of what we're generating. So everybody, thank you very much for your time. I know today's one was a little bit intensive in terms of formulas and could have been a little bit intimidating, but I think once you understand it, it's actually a very, very simple concept to understand, but an extremely valuable tool. So with that, thank you, everybody, and we'll look forward to seeing you next week.